I think we are, Becky, seeing something very similar to February and March when we had that pullback. Only now I think we got a confluence of factors, whether it's rising rates, whether it's trade tensions. We've got the uncertainty with the midterm elections. But last week, what we saw was the typical post-Fed blues. And we've been writing about this in our commentaries for quite some time, how the market tends to, since the rate hike tightening cycle began in December 2015, a month following the rate hike, the market is down on average 1%, whereas when the Fed holds, a month later, the S&P is up about 1.5% on average. So we had that rate hike that came at the beginning of the month. We had some technical levels break, and then back to Larry Fink's comment about fear in the market. There was a lot of put open interest. In other words, a lot of insurance are right below the market. And sometimes those puts, when they build up, they act like big magnets. And with us so close to October expiration, I think we saw some accelerated selling as those put strikes came into play. And so I think we had a combination of technical factors, some macro factors, and then finally options and options expiration being around the corner, and those puts. Those insurance bet, I wouldn't call them bets, but a lot of portfolio insurance out there, and it just becomes a self-fulfilling prophecy almost.
All right, we'll come back and talk more about that in just a moment. But, RJ, if you've been watching the yields in the Treasury market, look, yields came up, but then when we saw the market sell down, the yields have moderated some, too. What is that telling you?
Well, good morning, and thanks for having me. The backup in yields reflects the fact that the economy is doing pretty well. Inflation remains biased upwards, and the Fed keeps tightening. As was just mentioned, we've seen a lot of tightenings for a number of years now, and it's part of a normalization process. I think the market is struggling a little bit now with whether monetary policy normalization will tip over and become tightening, imparting restraint on financial conditions, slowing the economy, and if it becomes too much, then it sows the seeds of a recession. I think that's what we saw in the equity markets, aggravated by technical factors, as was just mentioned.
Sure.
I'd like to point out, I think the stock bond trade is somewhat self-limiting. As rates rose quickly, stocks reacted negatively, and that helped calm down the rates market. These are endogenous dynamics to the marketplace.
Right. So healing thyself, so to speak.
To some degree, yeah.
Let's talk a little bit more about this. Just the idea of the Fed going too far, because that is a huge debate right now. Are they raising rates because the economy is very strong and they should be doing just that? Or are there signs that things are already under some pressure and maybe they should take their foot off the gas? If you want to look at housing, what's been happening, that's been a huge problem. Auto loans and just auto sales in general have come under some pressure on this. You would think the consumer was feeling a lot more flush, given some of the wage increases you've seen. What do you think's happening?
Sure. I think if you look at the Fed's dashboard, and I'd like to reduce it to their dual mandate, maximum employment, sustainable prices as defined by a 2% inflation rate. Inflation is at their target. That's great. They have to feel good about that. It took years to get there. And unemployment is the lowest among the last 50 years, 3.7%. It's very rational for the Fed to drive the Fed funds rate above zero on a real basis, which is basically where it is right now. I think the Fed is doing their job and doing it well. I think it's going to have an impact. The fact that housing is rolling over is the first sign of that impact in terms of interest-sensitive sectors.
Yes. All right. Todd,
I don't think.
Oh, go ahead, RJ.
I don't think it's excessive. I'm sorry. I don't think it's excessive just yet. The real Fed funds rate is basically just above zero. By any metric over history, that is not a highly restrictive monetary policy. I think the challenge to the market right now is Chairman Powell has very clearly downplayed R-star, this idea that the Fed knows where it's going. And so it opens up a broader range of outcomes that introduces risk. Risk premiums have to go up. That's a challenge to financial assets.
Todd, let's talk more about what happens next with the market. If this was a strange confluence of events, that means that you're looking at this as an opportunity to buy?
Becky, I think it could be a bottoming process, again, much like we saw in February and March. I think we are at some potential support levels. The danger with that, of course, when you've been up so much is you can continually draw these lines in the sand. You know, in the Russell, for example, it's back to around its year-to-date break even, and I've seen many times on these major indices where we bounce from these round numbers. Just as the S&P stalled at 10% year-to-date, the Russell could very well bottom here around year-to-date break even, and we are that accelerated selling I was talking about that I think was helped along by the options market. I think most of that is over, and those forces that drove the equity markets lower, those could be the same forces to the degree some of these put strikes that are still out of the money. As we near expiration on Friday, you could have some short covering that helps support the market. So the opposite forces could very well be in play over the next week or two. But I wouldn't be surprised if 3 weeks down the road or so we do a retest before we finally bottom out. But I do think we're near a bottom at this point.